Good afternoon, ladies and gentlemen. Your webcast is about to begin. Jeff, please go ahead.
Hello, everyone. This is Jeffrey Metz, and I'm here to welcome you to today's webcast, Big Opportunities in Small Properties, a practical guide to financing small multifamily assets and single-family rental portfolios. This event is brought to you by Globesheet.com and sponsored by Arbor Realty Trust. Before we get to the presentation, let's get some simple housekeeping items out of the way. This event is completely interactive and incorporates many of today's social media tools. You can tweet or directly post information to Facebook or LinkedIn right from the console without opening a new browser. Just scroll along the bottom of the screen and click on the social networking widget of your choice. In fact, we encourage you to do so. In addition, if you have a question for one of our speakers, please enter it into the Q&A widget on your console. We will get to your question during the event or during the live Q&A at the end, depending on time. We will answer as many questions as possible, so we invite you to ask away. And if we don't get to your question, you may receive an email response. Also, there are some other customizable functions to be aware of. Every window you currently see, from the slide window to the Q&A panel, can be either enlarged or collapsed. So if you want to change the look and feel of your console, go right ahead. I'm about to hand over to our panel, but let's take a quick poll to see what is bringing everyone here today. Are you interested primarily in small business or balanced multifamily loans, single-family rental financing, all the above, or you're not sure? We're going to take about 30 seconds so everybody can get their response in, and then I'm going to hand it off. Looks like they're coming in. Okay. Okay, Sam, would you like to take it away?
Thanks very much, Jeff, and welcome to everyone participating in today's webinar. I'm Sam Chandon, the Silverstein Chair of the NYU SPS Schack Institute of Real Estate. I'm delighted to be joined by today's panel, Ivan Kaufman, Chairman, President, and CEO of Arbor Realty Trust, Dave Leopold, the Vice President for Affordable Housing Production and Investment at Freddie Mac Multifamily, and Steve Johnson, Vice President for Small Balance Loan Business, also at Freddie Mac Multifamily. To kick us off, Ivan, tell us a little bit about Arbor's business.
Okay, Sam, let me give you background on who Arbor is and the kind of products we do and where we're most active. First of all, Arbor is a publicly traded REIT listed on the New York Stock Exchange. We're a leading provider of debt in the capital structure for multifamily and commercial real estate, and now very active in the single-family rental space. We are not only originators, but we service our own loans. And on top of that, we have a significant balance sheet of over $3 billion worth of loans to provide bridge and mezzanine and preferred equity capital in all sorts of financing. We're an approved seller servicer for Freddie Mac, Fannie Mae, and FHA, and we're active as well not only in the single-family rental market, but senior housing and healthcare. And this space, this new space of single-family rental, we've been approved by Freddie Mac as one of their approved seller servicers. It's a new space for us, but not new to what we do. I go back to 1983, where I was one of the most active originators of residential loans. I still own and operate and participate in a leading provider of residential loans in the United States. So I'm back in a space that we're extremely comfortable. I'm very excited about the relationship we have with Freddie Mac and the liquidity that they're bringing to this space.
Thanks very much, Ivan. Steve, can you tell us a little bit about multifamily business at Freddie Mac?
Absolutely. So most of you know that Freddie Mac is one of the agencies, typically referred to as one of the agencies, which includes a firm across the river in D.C. who I will not name on the call today, Fannie Mae, as well as the home loan banks. Our business itself at Freddie Mac is divided into three distinct lines: multifamily, single-family, and an investment piece. Multifamily actually uses a disproportionate percentage of the capital of the firm and actually produces a disproportionate percentage of the firm's profit. We are, in fact, a monoline, so the people, process, and technology within multifamily are specifically focused on driving liquidity to every corner of the multifamily market. We are an awfully driven group of people. You'll see a few numbers on here. One, $73.2 billion. I think in any estimation, that is a significant number. We are one of the largest players in the space. The other number that I would point out is 80%. So 80% of the units that we funded last year were affordable to those individuals earning area median income. This means we are absolutely 100% focused on workforce housing. As I mentioned, we are a driven lot, so that means that we are not done. And one of the reasons we're here today is to talk about two specific product innovations that we put out over the last few years. That first being small balance loans, again, launched in 2014, and Dave Leopold will talk in a moment about our single-family rental execution. Small balance loans, a product business that we wanted to be in for a very long time, and was something that we did off the side of our desks at Freddie Mac, and weren't able to enter the space. We were able to do that in 2014, and the thing I would mention about that is we built this business for today's small balance, small property borrower. We work with our sellers, and specifically with Arbor, to design a product that works for today. We worked in our credit culture, our credit risk transfer execution, to build something that is specifically focused, again, on workforce housing. If you look at the numbers, we've had tremendous growth since 2015. And you see units, you see balance. One of the other numbers that's not on here is actual numbers of loans, 1,000 loans to 2,000. This year we will be over 3,000 loans. And just a moment to promote the business a little bit in 2018. In almost every category, we are breaking records, whether it be affordable units, whether it be volume, and we expect that trend to continue through the balance of the year.
Dave, can you tell us a little bit about the single-family rental pilot?
Yeah, I'm happy to. So David Leopold, Freddie Mac Multifamily. Steve just mentioned how excited we were to get into the small balance space. We feel the exact same way about single-family rental. This is something that Freddie Mac Multifamily has wanted to get involved in for a long time. We think it's important for us as a firm to serve all aspects of rental housing within the United States, and single-family rental has long been a critical component of rental housing in this country. So last year we launched a pilot. That pilot had resulted in our building out a platform through which we can deliver liquidity to single-family rental portfolios. Our focus is on the middle market space. So these are professional owner-operators, so businesses that are generally owning between 50 and 2,000 units. And we're squarely focused not only on that professional management and quality housing, but also on affordability. And we get a little more in deep depth into that in one of the later slides. So the pilot is launched. We are thrilled to be offering liquidity in this space real time with Arbor as one of our key partners in the effort. And as we engage in the pilot, we're continuing to augment our offerings, and I'll talk in more depth about that a little later in the deck as well.
Great, thanks very much. Well, one of the questions that ultimately arises is, who owns small balance properties? Who's investing in single-family rental properties? So much of the research in our industry focuses on the institutional investor and the institutional borrower that it's useful to illustrate, some of the actual data points here. And I think what you see on this slide is that the vast majority of the individual single-family rental properties in the United States are owned by individual investors. The next largest share being LLCs or LLPs. Even when we move to small balance properties, 5 to 50 units, what we see is that the majority of the ownership is either individual or LLC, LLP. When we move to the largest segment of the market, those properties that are 50 units or more, the institutional ownership, the REIT, the corporation, again, although it is the focus of a lot of the research and a lot of the dialogue in the industry about what's happening with cap rates, what's happening with investment and lending volume, that accounts for a relatively small share. I think what this really does illustrate for us is that there are opportunities for investors at a range of scales to participate in this market. Dave, in your activities, can you tell us a little bit about the partners that you work with?
Sure. So again, we want to serve as much of the market as possible, but we also do require professional management, professional ownership. So As the slide clearly identifies, a large portion of the single-family rental in this country is owned by what you can think of as mom and pop. So these are owners that maybe have 10 or fewer units, and those tend not to be a very good fit for Freddie Mac because they lack the business infrastructure that's necessary to meet our requirements. So we're focused on those owners that have that business infrastructure, that have that professional management, generally characterized as 50 units or more. There is no size above which we wouldn't go, but we are much more focused on quality and affordability.
So it's very interesting. There are a lot of parallels between what's being done now from Freddie Mac's standpoint and the industry on the single-family rental as what they did 4 years ago on the small balance loans. The small balance loan market was very, very inefficient, and it was also owned and operated by people who have 1, 2, 3, 4 properties. When Freddie Mac came along and we worked together with them to develop the program, it allowed these operators to access financing with certainty. It lowered the cost of financing, and that liquidity allowed them to go out and buy and build their infrastructure. I believe that's what's going to happen here. You're going to take the operators and make them bigger. You're going to give them liquidity, low-cost financing, and certainty. And a firm like Arbor is not only going to be helping them through Freddie Mac execution, but we're going to be providing them aggregation facilities so they can build up their portfolio. And we're going to help take them to the next level, just like they did on the Freddie Mac small balance program.
So Ivan's described how the market as recently as perhaps 5 or 10 years ago was relatively fragmented and efficient, but Arbor's work in particular with Freddie Mac has seen a significant innovation in this space. So could you tell us a little bit about what that small balance loan looks like?
Sure. So a couple of different ways to sort of describe what small balance loan is. First of all, the name itself, I think we originally came up with that. If I could go back, I might have called it small property loans or something catchy, something like that. But we're SBL, and we're going to always be SBL, I suppose. But it really is smaller properties. Specifically, just some averages for you that I think accentuate the idea. We did $6.9 billion last year. That is a significant number. We got to that number by doing lots and lots of loans. The average loan size remained $2.5 million, $2.6 million, 38 units. Affordable to folks. 70% of that business was affordable to folks making 80% of area median income. 25% of that business was affordable to those making 50% of area median income. So that smaller property, affordable, what we refer to as workforce housing. The folks that are living in these properties are your policemen, your firemen, construction workers, really sort of that core working workforce housing class of the country. So that's sort of an idea about what a small balance loan looks like. One of the other comments on here was, why was the program launched? And I think Ivan hit it on the head. Really, we saw an opportunity. We are a monoline, as I mentioned. My dad always used to tell me, if you work for a rocket company, be really good at making rockets. Well, we're really good at doing multifamily business, and we felt like with a partner like Arbor, we could get into the small balance, small property space and drive real change as it related to consistency, reliability, so that borrowers knew they could do a loan and yet come back, and that same execution, that same process would still be in place, and they could build their portfolio from that perspective.
Dave, could you compare and contrast that for us with the single-family rental loan?
Sure. There's a lot of similarities, particularly the focus on workforce housing, right? So rental properties that are providing decent rental housing for moderate income individuals. That same focus is part of the single-family rental pilot. We got into this space because we think that the market is disjointed. We think that it also lacks the focus on quality that Freddie Mac, together with Arbor, bring to our loans. We do have an additional affordability threshold during this pilot phase, and that specifically, as articulated in the slide, is if the majority of the properties are affordable at 80% AMI or below, or the rent levels are affordable to households making 80% of the area median income, then it's all systems go. If it dips below that threshold, we do have an additional vetting that we can do in hopes of getting to other affordable portfolios as well, with the theme being focus on workforce housing. We have a higher minimum than Steve has in the SBL program. We have a minimum loan size of $5 million. The primary reason for that is that we do need that business infrastructure to describe. Steve described an SBL deal. To describe a single family rental deal, it's generally a portfolio of single family rentals with some market diversification, concentrated in a few jurisdictions, right? So we recently closed a deal that had concentrations in Cincinnati, Indiana, and a couple of other markets. And that's a standard deal, and to be able to adequately manage that, you do need a level of business infrastructure, and that's one of the key reasons for the $5 million minimum. The other is that these deals take a little bit more to diligence, right? There's a lot of units out there, and we're consistently looking for ways that we can get more efficient in terms of how our diligence process is able to digest those multiple unit portfolios very quickly.
I think that you're right. Businesses are close together. I think what we're working through is how to work together. So a lot of similarities across the boat. What we'd like to think is you bring us a deal, and Dave and I are going to figure out a way to do that deal. It's going to bring out our ability to work together and create synergies as it relates to that.
I think what's exciting for me is I want to use the phrase, come grow with us. If you take where things were in 14 on the Freddie Mac small balance and where that program was and where it is today, it's very, very different. So this is new for Freddie Mac. It's new for us. It's new for the market. It will evolve. And as we get to understand it better, the products will be broader. And most importantly, Freddie's focus is on affordability. And to the extent that they can put their attention, improve the housing stock and the liquidity and affordability for that renter, this will be a ever-changing and dynamic product. So get on board and let's grow together.
Yeah, I'd be one last comment on that, and it would be that it'd be remiss not to mention the appetite in the capital markets ultimately for the bonds that we're producing, for the credit risk that we're transferring. Our securitization vehicle, and I'm guessing it'll be exactly the same thing on the SFR side as that business gets going, really our ability to draw in cost-efficient capital from the capital markets, so which has been, the SB deal has been a resounding success, and so we'll expect nothing less from the single-family rental side.
I'm going to jump in for a moment with some macroeconomic context for our discussion as we continue with single-family rentals and small balance. I think anyone certainly watching the Treasury yield space knows that the economy is firing as close to all cylinders as we've seen over the course of this expansion, and those numbers begin to rise. We'll get more macroeconomic data over the course of the next few weeks, in particular, that all indications will support the FOMC's and the Federal Reserve's path to interest rate increases over the course of 2018. To give you an idea of what's behind some of that, let's first look at employment growth trends. And although we have a lot of blue dots here that are very strong markets and red dots on this chart that are markets that are growing a little bit more slowly, I think what we can offer as a general characterization is fairly consistent growth across the country. It is, of course, the case that we have some parts of the country that are strongly outperforming. And what this chart really indicates for us is that a lot of those markets are on the West Coast. They tend to be tech-driven markets. They're going to be Seattle, Portland, the Bay Area, Southern California, are again really some of the strongest performers in terms of what we see happening with employment. The other thing that you can see on this chart is that unemployment rates are sort of at cyclical lows, and the expectation, I think, on the part of many economists is that they will continue to tighten further. The challenge for us in doing the analysis is that these levels of unemployment, we should observe stronger wage and inflationary pressures in the economy than we have so far this cycle. And those are things that are, I think, again, beginning to become more observable over the course of 2018. And part of why it is that we see some of those interest rates begin to trend higher Of course, when we're looking at the unemployment and the employment data, what we know is that you can tell any of a number of stories depending on how it is that you want to characterize it, the lens you're looking through. One of the things that folks ask us about is why is it that if the market is strong, we see that the actual job creation numbers have been slowing down over the course of the last, let's say, year or 2 years. And what I would offer there is that it's not the case that employers aren't looking for people. What we actually see in the JOLTS data is that there are more jobs open and available in the United States today than we have ever seen on an absolute basis. There are a lot of jobs there. The challenge that many firms have is finding folks that have the right skills and are in the right place to actually fill those jobs. And so the ability of firms to, again, match up against the right person, employ them, bring them into the firm, is where we have some of those constraints. It's both a spatial mismatch, but a bit of a skills mismatch as well. So we don't want to read too much into some of that slowdown in the actual monthly job creation numbers. One of the things that the next chart will show you as well is that that job creation is not the only thing driving migration patterns in the United States. Certainly where we've had sort of strong migration into the West Coast, part of that has been driven by what we see happening with jobs on the West Coast, quality of life, low costs of living, good quality infrastructure and schools are also part of that story. But what you can also see is that we've got movements from east to west. We also have movements from north to south, where we've got Texas and Florida really strongly outperforming. But within metropolitan areas, we're also beginning to see, as the oldest millennials age, as their household preference patterns begin to change, in particular as folks get married and maybe have their first kid, that there is on the margin some movement from the most urban core area into relatively more suburban areas. And a big driver for that in a lot of cases is that, again, what drives those changes in preferences for a lot of young families, it's for the first time needing to prioritize access to a good quality public school. Of course, when we look at this next slide in the section, then one of the things that is apparent from this slide is that interest rates are on the rise. I wouldn't characterize this as a negative. I think what this does reflect for us, what is reflected by the marginally higher rates of inflation in the U.S. economy, is that people's wages are beginning to rise. That supports their ability to pay higher rents, supports discretionary income growth. But it is because of that alignment of very strong drivers of economic activity that we see out there right now, independent of the question of the longevity of this cycle, that we do see this beginnings of a rate rise. And I guess the question that I would put to the folks from Freddie Mac and Ivan as well, what's been the impact of this on the borrowing environment? I think from my perspective, although rates have increased by any historic norm, rates are still exceptionally low.
Yes, this is Dave. I'll say two things. One, the rate increase in the index has been coupled with a general decrease in credit spreads, which has mitigated the overall rate rise in the coupon to our borrowers for the most part. So that's been a positive thing. The other is we have seen a switch from primarily interest in variable rate financing to primarily an interest in fixed rate financing.
Yeah, I mean, if you just take a look at where the 10-year went, it's up about 100 basis points, and spreads have tightened, I'd say, about 50 basis points. So there's been a real tightening. And it is interesting to note that there is a shift from the variable rate product into the fixed rate product, because LIBOR has moved up, and there's also a feeling LIBOR will move up more. We're actually doing more 12 and 15-year loans than ever before. The spread between a 10 and 15-year loan is almost nominal. And then what we're seeing with a lot of our borrowers on a 15-year deal, they get a lot more IO, interest only, so it becomes an even better product. So in many ways, we're kind of happy. We like longer-term financing in place. It's more certainty, and there's less of a mismatch. But there is a little bit of a pinch. On the other hand, there's so much liquidity in the system that people are more aggressive. And since they're more aggressive, it hasn't really impacted the way it should.
I think they've. This is Steve. I think that they've covered it. I think sort of a pitch that I would make is in this kind of environment, you're going to want to know certainty of execution. If you're interested in getting a deal done, and you're going to want to know that the coupon is held in incredibly sort of volatile interest rate environments. And I'll just throw this out there. That is one of the cornerstones of the small balance loan business. We have that option. There's no cost to the borrower, and it's something that's going to continue to be incredibly important in how we conduct our business going forward.
Right, I think in a moment we're going to dig in on a little bit more detail around exactly how the products work, but also some case studies for individual loans that have been made. Before we do that, just a moment to size out the small balance and single-family rental market. And I know so much of the research and dialogue in our industry focuses on that very large Class A urban core property. When we actually look at the rental demographics in the United States, I think what you can see is that the majority of renters in the United States are not living in that 100-plus unit building. The majority of renters in the United States live in relatively much smaller properties. And that covers the gamut from that single-family rental property, which accounts for 36% of the rental inventory, but importantly 45% of the rental population. That reflects is that the average household size in that single-family home is going to be a little bit larger. It might be a family that has their first kid or their first two kids, whereas the studio apartment in a very large building is invariably catering to one or two individuals. When we look across that spectrum, then we can see sort of that that single-family rental market, the duplex, quadplex, the small apartment market, 5 to 49 units, again account for sort of a very large share of the overwhelming majority of what we see happening in the rental residential market in the United States. Another really interesting feature, because so much of the dialogue and the narrative in the industry is focused on the desire of millennials in particular to live in that urban core, the walkability, the lifestyle, the amenities. When we look at where people actually live, what this chart shows is that the relatively larger buildings tend to cater to relatively older families. And when we look at relatively younger Americans, we look at relatively younger households, what we see is that they do tend to be in, on average, relatively smaller properties. That reflects a number of different things. Your smaller property, on average, is going to have fewer amenities associated with it because of the smaller size. It does tend to be relatively more suburban or in a transit-oriented community outside of the urban core. All things being equal, it tends to be a relatively more affordable unit for that smaller or younger family. And so while we think of millennials as wanting to gravitate into the urban core, what we actually see is that this population, again, we should not think of millennials as being a homogenous group. It's an incredibly diverse population, probably the most diverse demographic that we've seen in U.S. history. Their housing preferences do tend to favor relatively smaller assets. What we also see when we look then at what's happening with again, sort of, those questions around affordability, sort of as a policy person, certainly a concern for me has been the rate at which we've seen, rent growth in the United States relative to what we've seen happen with household incomes. One of the areas where I think we've got a positive here is that income growth, still not what it should be in the United States, but certainly has been making meaningful and consistent improvements over the course of the last couple of years, alleviating some of that affordability pressure in the market. But when we also see sort of, what's happening with renter-occupied housing by units and structure, what we can also see there is that the home ownership rate certainly has been declining in the United States. Some of that decline, and that's been really one of the sources of significant pressure on occupancy rates, on rents in the multifamily stock in the United States, as well as the single-family rental stock. As homeowners, that decline in home ownership rate has begun to level out, has improved a little bit over the course of the last several quarters that we have reporting from the American Community Survey. Some of that pressure begins to alleviate. And you can see that sort of on the next chart that shows average asking rent and vacancy rates, a combination of more stability in the single-family ownership market than we've seen over the course of this cycle. Certainly new supply that has come online in the multifamily sector, concentrated in the urban core. This data from Reese shows us that those vacancy rates have edged up just slightly. Again, by any historic norm, the multifamily market in the United States remains exceptionally tight. Our expectation is that while there will be individual markets, there will be localized oversupply in some parts of the country, some submarkets within the markets, that overall, when we look at the number of housing units of any type that have been introduced in the U.S. inventory over the course of this cycle, relative to the number of households we have out there, we're not significantly out of balance. In the multifamily market, again, we do have that slight increase in the vacancy rate, and what you can also see here is that in tandem with that slight increase in vacancy, we have a slight tapering of the rate at which rents are growing when we look at the multifamily stock overall in the U.S. When we look at sort of, what some of those top performing markets are, Birmingham stands out actually as our top market over here. That may catch folks by surprise because we tend to, I think, fixate our attentions on primary markets, or certainly those of us who live in New York City can't imagine that there might be another market that's quite as expensive as ours or where rents are going up quite as quickly. But what we see is that, particularly for relatively smaller secondary and tertiary markets, if they have a core industry or a foundational industry that is really, performing, very, very strongly, that can drive very strong outcomes. These are relatively smaller markets, and a sudden influx of new labor responding to employment opportunities can drive very strong employment growth. We have to balance that in our thinking about risk around how it is that any one individual market might be overweighted to or over-concentrated in a particular industry. But I think it's no mistake that when we look at these top markets, what you see really dominating your list is markets that are in the South and on the West Coast. And that is consistent with what we see happening with a lot of the job and migration trends in the United States. The next thing that you can see when you look at this chart from Real Capital Analytics on multifamily sales activity, multifamily, better than some other sectors, has been very stable in terms of the level of investment activity. But what we also see is that when we look at cap rates, and it sort of really reflects on a point that Ivan has made, as interest rates have begun to increase, I think all of us certainly over the course of this entire expansion have always in the back of our minds had this question around, okay, well, when rates do rise, how much of that rate increase will be absorbed into spreads, how much will manifest as higher cap rates or debt yields. What we see in the multifamily sector is that there continues to be some compression of those spreads, but relative stability in pricing and cap rates and debt yields really across very, very wide range of markets. The last couple of slides in the section, again, illustrate what are some of those top markets for single-family rentals. I think what might jump out for folks when they see Stockton at the top of this list, and then New York City or the New York metro area a little bit further down on the list, is that when we do look at some of the markets in California, other parts of the country, while they may not have the absolute numbers of residential units that we've got in New York, they tend to have more single-family 2 to 4 unit properties, whereas in New York, on average, our buildings are going to be relatively larger, and that's going to be reflected here. So New York, in terms of absolute numbers, may have a very, very large number of units, but on a relative basis, we're going to see Stockton, Fresno, Honolulu, Las Vegas, LA, San Diego, where the relative shares of the inventory do weigh towards the single family, the 2 to 4, the 5 to 10 unit building. The last piece here, and then I'm going to hand it over to Steve to tell us a little bit more about how the specific loan products work and how it fits with these opportunities, is where is some of that opportunity? And you can see here on slide 21, we described some high yield markets where Cleveland has a relatively high cap rate, some markets that have in terms of upside potential. I think when we're looking at these charts, of course, what we want to keep in mind is that it's reflecting a number of different things. In a market like Cleveland or Columbus or Memphis, Philadelphia, what we're going to see is that in part there's a reflection of differences in liquidity across markets, differences in concentration in terms of the employment drivers in these markets, differences in the quality and relative newness of the inventory. But I think what is really important to see here, of course, is that then you've got also a market like Detroit, and there are very localized issues there. When we look at the downtown core of Detroit, an urban renaissance that perhaps 8 or 9 years ago, when we were working through the details of bankruptcy and restructuring, would not have been apparent. But we do have sort of your really great drivers of outcomes in downtown Detroit, and each one of these markets is going to have a very unique story at the market and sub-market level around what it is that is driving growth. And of course, like any market, what are the unique set of risks that might be driving selection bias in terms of what's actually transacting. And so with that in mind, I'm going to actually pass it back to Steve to tell us again a little bit more first about the small balance loan program at Freddie Mac.
Great. As I mentioned, shamefully, I suppose, jumped the gun a moment ago, rate volatility has created a tremendous opportunity for the execution itself in the form of a coupon guarantee. So we offer that as a core piece of the business. And specifically, you get your business, your full underwriting package in 35 business days, your coupon is held throughout. I can't emphasize how important that is. You'll hear all kinds of different variations with maybe other competitors in the market, but I lead with this because you don't lock it in. Tomorrow you're going to could be kicking yourself because of the environment we're in. And this is every time this is one of those things that comes back to us that's important and gets to this issue of rate volatility. The other thing is that is something that Ivan mentioned a second ago, which was around what liquidity does and really cost-efficient liquidity. When it's done right, you have these opportunities for borrowers to go out and acquire, take their one or two, refi, go out and acquire 3 or 4, and all of a sudden they've got a portfolio of $50 million, $60, $70 million in smaller properties, small balance opportunities. And that has translated into what is becoming a bigger and bigger percentage of our business, which is portfolio execution. Which lines up incredibly well with what Freddie Mac Multifamily has done for many years. This idea of taking an execution that has varying terms and there could be exceptions that need to be worked through. That lines up perfectly with our credit culture. We have people on the ground in markets who understand real estate. We work with our sellers to work through those executions. And the other piece of that is that these portfolios also tend to be very affordable and specific to workforce housing. So that is one of those incredible opportunities where our culture in multifamily has been around for a long time, lines up with what the market needs almost perfectly. The other thing I would mention here is 1 to 6 million nationwide, 5+ units, and 6 to 7.5. Really, the business goes up to 7.5 million. We've made some recent changes that I would point out around numbers of units between 6 and 7.5 million. And there I would mention there is an opportunity in the business. Our due diligence between 6 and 7.5 million, essentially the same as between 1 and 6 million. So you're going to have that same type of execution. Now you can go up to 100 units. There really is an opportunity to drive a lot of business through that, and certainly in the top and standard markets. One other thing as we move to the next page is in this area, and I would harken back to a slide that Sam discussed a little while ago around 2 to 4 units. That has traditionally sat squarely in sort of the single-family realm, and I think this is something that Dave Leopold and I are working through. We happen to believe that there's quite a bit of that 2 to 4 unit business that's in the small balance loan world. And certainly, as Ivan has said to me before, these small property portfolio owners, typically some percentage of it, 50 million, 20 million of it could be this 2 to 4 unit business, feels like it's a small balance opportunity. And I would say that's something in the lab that we're kicking around. I don't know if, Dave, you have any thoughts on that and how we might handle it today?
Steve, I like the comment you made earlier, which is that that's not something that borrowers need to worry about. That's something that we'll figure out when a loan comes into the shop.
Yeah.
So transitioning back to single-family rental then, I'll hit the high points on our core product. Freddie Mac Multifamily's key value proposition is efficient long-term financing. So with the single-family rental pilot, that's where we're starting. So we have efficient fixed-rate executions, 5, 7, 10, interest-only periods available on all of them. We're a non-recourse lender. Loan sizing can be up to 75% LTV, 1.25 debt cover. And we're also trying to provide a variety of prepayment optionality from step down and yield maintenance is where we're starting. So one other key point that Steve raised and exists as a benefit in the single-family rental space as well is interest rate certainty, right? Again, key value proposition, volatile interest rate environment will hold your spread. Single-family rental deals take a little longer to germinate. So we'll hold your spread for 90 days as opposed to a traditional multifamily loan where Freddie Mac will hold it for 60. We'll hold it for 90 days at no additional cost to the borrower. We also talked about, we're focused on middle market borrowers, right? So these are borrowers that have business infrastructure. Generally, they own 50 or more units. The $5 million minimum is, in fact, a minimum. Don't worry about the maximum. We like big deals, and we'd like to see more larger deals. We are concerned very much about property condition, right? That's both going in. So we understand that a lot of these single-family rental owners are buying properties that need to be rehabbed, and we are open to doing deals that involve some rehab, but in general, we want to finance stabilized portfolios. Ivan mentioned Arbor's bridge loan capacity earlier. That's a very nice coupling to be able to take down some properties that maybe aren't yet stabilized and then deliver them to Freddie Mac Multifamily as a stabilized portfolio. That's a great model that we're executing under. And then lastly, back to the difference between single-family rental and SBL, right? They're small rental properties, and to the extent that you're not sure which side of the fence one will fall on, right? It's kind of, you know it when you see it, but if you don't, we do. So send it in, and we'll get it to the right home.
Ivan, can you walk us through a case study?
I can walk you through a case study, but before I jump into that, what's very interesting for us is that we're seeing a lot of crossover between our small balance borrowers who also own 2 to 4 units and single-family units. And we have an originations team of around 27 professionals, and we're getting a tremendous amount of flow. The case study I'm going to give you is actually a reverse inquiry for our 1-800 line, and it's very typical for what we're seeing. So in this case study, the individual owns 73 different single-family properties here in Baltimore, Maryland. The portfolio value is about $15.5 million. And they're looking for $11.7 million in refinance proceeds. There's going to be cash out between $500,000 to $1.5 million, which, by the way, is a great thing about the program because it fits the tricks. They don't have a problem with the cash out. In terms of qualifications, you're looking basically at 75% loan to value and a 125 coverage. This is something that came in, as I said, through our 1-800 line. We're processing it, but it's very typical to what we're seeing. And the responsiveness from Freddie Mac and the appetite and the flexibility, so far it's working out very well. I think the initial quote on this deal was somewhere in the 5s. Things have moved a little bit, and we'll see how that transaction is going to move along.
Can you tell us a little bit more about the benefits of working with Arbor, working with Freddie Mac? You described how this deal came about the dot to 1-800. Why work with Arbor?
So just like we do on a small balance situation, we can either go through Freddie Mac and do a execution with them. If the property is not ready, we can provide a bridge loan if they need some more proceeds before they turn that asset around. So we're planning on doing exactly the same thing for the single-family rental. We're going to have a bridge execution. We're going to have execution through Freddie Mac. We're going to try and help the borrower grow, and we're going to develop relationships with these borrowers to help them take their existing business and bring it to the next level.
And Steve, I would even sort of take a larger view of it in that this is a partnership. We treat each other like partners. We work through solutions together, and we have built this business together. We have what I would call muscle memory at this point. We know how to look at a property, and typically 99% of the time, how I feel about it is the same as what Arbor would feel about it. That translates itself into a 60-day close for you as a borrower. It translates into understanding issues that may or may not be at the property level and getting through those issues, finding solutions. And certainly from the Arbor perspective for your borrower, they have an array of products that you can work through. And I understand it's not always Freddie Mac, but so that's what you're getting when you sign up with this group.
And I think there's one other element. Arbor's servicing these loans. We have a continued relationship with the borrower. It's not a one-time transaction. And that's the beauty of dealing with us and Freddie Mac. Sometimes when a loan is brokered or goes through Wall Street or other venues, you never know who's going to be collecting your monthly payment. You never know who's going to be dealing with a potential issue down the road. When you deal with Arbor and Freddie Mac, all you have to do is pick up the phone, and we're servicing, and we're there for the life.
I would just mention that a lot of the press is on the front end of the business. Most of the press is about that. But to Ivan's point, the way you get refis is through the way you treat them through the course of their loan. And Arbor's customers come back every time.
We're going to jump into Q&A in just a moment, and just as a reminder to folks, there's Q&A functionality built into the webinar app. Before we do that, just a quick mention that we have 2 research reports that are going to be coming out shortly. The first is our Q1 2018 Small Balance Report that my team produces in collaboration with Arbor. You can find that on the Alex Chatter site, as well as a single-family rental white paper that Arbor will be introducing. So please keep an eye on your inbox for both of those research papers. We have a very large number of questions, and so I'm going to try to move through them as expeditiously as possible. The first, how important is it to have a professional property manager in place?
Speaking for the single-family rental program at Freddie Mac, it's vital. Yeah, it is a threshold issue.
Yes, it is. Small balance as well. It's incredibly important.
Is there any minimum occupancy threshold for the small balance lending program, and this is specific to multifamily?
Absolutely. And it would depend on the marketplace. It would depend on the deal. But there absolutely is, and 90%.
I think it's generally 90 for 90.
Yeah, 90 for 90%.
That doesn't mean that in certain circumstances, Freddie Mac won't have flexibility.
Right.
If it's a rehab property with strong market circumstances and units are coming online, they'll show the flexibility, but 90 for 90 is the general requirement.
Yeah, and I hesitate because that really is the point. It's certainly 90 for 90, but it's also there's flexibility within that. If it's a fairly new property, if it's got, there's any number of things that go into it, but that's typically where we end up.
So I guess a bigger picture question. I think this in part reflects sort of Ivan's points earlier about our moving from an environment in which things are relatively inefficient, relatively fragmented, to one in which things are more formalized. There's greater liquidity. To what extent are you seeing consolidation of relatively smaller portfolios to larger owners, and is it really sort of in line with what your expectations would be?
In the single-family rental space, we're seeing a lot of consolidation. It seems like just in the time period of our pilot, which is relatively new, less than a year old, we are seeing accelerating consolidation toward more professional, more efficient management, larger portfolios.
And on the multifamily side?
I think you're definitely seeing that on the small balance side, and Freddie Mac's program has assisted in doing that. When you have reliable financing and you could buy multiple properties, it also allows you to raise your equity very easily. So the evolution that's happened here is it's very typical for the small balance person to buy 5, 6, 7, 8 properties a year and build his portfolio.
Originally, the first year of the program, I don't even think we used the word portfolio. It might have been a couple loans, but now you're talking about $80, $100 million portfolios, 15, 20 properties. So it's absolutely, and again, something that we do very well.
So our next question is a little bit more about sort of that upfront execution on the part of the borrower. And if you could sort of describe for us a little bit about what does that initial process look like for the borrower? They reach out. Are there initial due diligence fees? Are there walk us through what the experience of the borrower will be from the time they reach out to you to the time that they're sitting down to close?
Well, Sam, as you know, we have a product called Alex. It's our automated online origination system. I think the first time a borrower uses it, it can be a little strange, a little new, but once he gets used to it, it becomes a very easy process. So especially on the small balance side, when the number of loans that are being done are greater, when you use our online origination system, it becomes very easy to do. In terms of the fees are very standardized. They're reduced. Do you know what the fees are, Steve?
It actually depends on competition within the market. I mean, where there's more competition, the fees will go down. But if you want to say what is standard, it's like in that 10.5 to 12.5. But if there is competition, it's going to go down from there.
And the 10.5 includes your legal fee, your appraisal fee, your environmental fee. So it's an all-in-one fixed fee. It's not a variable.
Yeah, I'm sorry. I was thinking origination fee, not closing costs. But that's closing costs altogether is about around $11,000-12,000.
And then single counsel also.
Right.
There's actually a fantastic question I'm going to put to Dave and Ivan. You've described the single-family program as a pilot. Question from the audience. What exactly do you mean when you describe the single-family loan program as a pilot, and where do we go from here?
Sure. So this is Dave. I'll take that. Our intent is to be a long-term liquidity provider in this space. But as we're regulated and also under conservatorship by FHFA, and the approval to engage in single-family rental lending is currently in a pilot phase, and so any continuation of the pilot, which again we're building in business infrastructure so we can be in it for the long term, but our ability to do so is going to be governed by our regulator.
The next question that we have then, to build on that, you've described how that borrower that you're working with has some scale, has the business infrastructure in place. Are there programs available that would support someone who perhaps has a portfolio that falls slightly below the threshold, or who is looking to build out that business infrastructure?
So what we're looking to do at Arbor is to provide bridge opportunities so they can build up that portfolio over time. So if the threshold is $5 million and they're $4 million, we'll provide them intervening financing, let them aggregate more, and then execute through Freddie Mac.
When we're looking at the kinds of net worth or liquidity requirements that the individual may have, either with the formal pilot program or with the program, Ivan, that you've just described, what are you looking for in that borrower?
I'll let you handle the liquidity for Freddie Mac and how you're looking at it.
Yeah, generally, so it depends on loan size. Absolute minimum net worth is generally about $5 million. As for liquidity, we're looking for a minimum of 10% of the loan amount.
This is another question that's come in that's pretty interesting. In terms of what happens with these single-family rental properties, what kinds of requirements or stipulations are there? And the question is being asked actually specifically in terms of Airbnb. Can I use this as a means of obtaining financing to ultimately use my property to bring in an Airbnb client?
I believe there are leasing requirements, term requirements. I don't think Airbnb fits into the requirements that we have in lending for certainty of the lease requirements, and I believe the lease requirements we generally look at a year.
That's right. Yeah. So minimum lease requirement of a year, and that Airbnb or there's some other similar apps out there that would be inconsistent with our single-family rental pilot.
A question about sort of the crossover between the programs, Ivan, that you described earlier. To what extent are you seeing your multifamily investors and clients, borrowers, looking at opportunities to cross over into and expand their portfolios into the single-family business as well?
So what's interesting is, unbeknownst to us, a lot of our small balance multifamily borrowers also have single-family and 2 to 4 family ownership as well. So they already have that crossover. I believe that with this product, with this liquidity, they're going to grow out their size single-family rental business.
Yeah, and we haven't seen, there was some notion, I think, at some point that you'd see sort of larger typical institutional investors, maybe increasing yield and dropping into the smaller balance world, and we've not seen that as a trend that's got any sort of steam with it. Really, the crossover is SBL to SFR. Right?
How does the program work with respect to acquisition financing, but also construction financing, if at all?
So for single-family rental, acquisition financing is absolutely available. Again, that's a big part of what we're doing. Construction, it depends on the portion. So we understand that some portfolios, particularly after an acquisition, need some TLC, and there'll be some rehab involved. We're generally looking for stabilized portfolios. So beyond what I'd call moderate rehab, then you're probably going to need some kind of bridge product, and we'll enter as the financing once it's stabilized. And as far as ground-up construction, we're not currently a ground-up construction lender.
Is there anybody even building small balance properties these days? I mean, it's one of the tricks, right? Is that the stock is deteriorating.
I think the small balance properties are not being built. What you're really seeing, and why we do so much bridge financing, is the renovation of those properties to get them stabilized. And the bridge product we're designing on the single-family side will be for the people buying these properties. They'll need a construction component. They'll need to get the tenant in. They'll need to build up the critical mass to actually then access the Freddie Mac product.
The next question relates back to, Ivan, your case study with the hybrid ARM. What kinds of trends are you seeing, and what do you expect to see with regard to the balance of fixed rate, floating rate mortgages, in terms and durations?
I think you're going to see basically a 10-year product with a 30-year amortization. That's going to be the product that people are going to go for. They're going to look for stability, and they're going to look to have the right maturity.
Gentlemen, that is all the time that we have for today. I want to remind our guests first, thank you for joining us. Also keep an eye out for that Q1 2008 Small Balance Report, as well as the white paper on single-family rentals. Please join me in thanking our speakers and panelists today: Ivan Kaufman, Chairman, President, CEO of Arbor Realty Trust; Dave Leopold, Vice President for Affordable Housing Production Investments at Freddie Mac Multifamily; and Steve Johnson, Vice President for Small Balance Loan Business, also at Freddie Mac Multifamily. I'm Sam Chandon, the Silverstein Chair of the NYU SPS Schack Institute of Real Estate. Have a wonderful day.
Thank you, Sam. And just one last reminder, if you missed any part of this presentation, it will be archived shortly, so you can view it again or refer it to someone else. Have a great day.